In South Africa, Monetary Policy Committee meeting wrapping up today, and it is widely expected that we'll see rates unchanged at 7%. Do you think this is wise, considering that retail sales contracted by 6.6% in November, and most of the retailers say that the retailers didn't do that well in the month of December?
I think we got a lot of those retail numbers, a lot of the earnings guidance from the likes of Mr. Price, ShopRite, and a lot of those other retailers, and they do point to lower sales. There's probably more disappointment than any kind of positive surprise there. So the retail side, the public sector consumption is quite, let's say, poor, weak at the moment. But I think there are other factors that the Reserve Bank will consider. The outlook for where inflation's going, inflation expectations. We've just seen ABI and SAB looking to settle things more around the 8% rather than the below 6%. So there's still a lot of pressure from the wage side, the concerns about what electricity, these hikes are going to do to inflation. It is more cost push rather than demand pull. So, there is scope, one could say, to reduce rates. But I think overall, if you look at all of the other indicators as well, manufacturing starts looking like it's picking up, mining as well, vehicle sales. There are a lot of those old green shoots we used to talk about. So I think to now start still reducing rates, it's probably the wrong thing. But I think we're going to get a good explanation from the governor today.
It's relatively evident that the South African consumer is under pressure. We're not demanding credit at this stage. We're trying to save, we're trying to deleverage. And we also know that the South African consumer accounts for 60% of South Africa's GDP. So given that the South African consumer is also worried about retaining their job, shouldn't we see another rate cut? Perhaps it'll be more of a psychological impact rather than a physical one.
Yeah, I think you hit the nail on the head. There is a lot of deleveraging still going on, and people and households are trying to repay debt rather than engage in any new debt. And we'll see with the credit extension figures, they also come out on Friday, where we are in terms of bank lending credit. But there isn't a propensity to go out and take out new loans at the moment. And I think if we reduce rates by another 50 basis points, I don't think that's going to inspire people to go out and start borrowing wildly again.
Also, just looking at the inflation figure that's set to be released tomorrow, we are currently in the target band of between 3 and 6%, but only just at currently 5.9%. What are you expecting on that front? Do you think we'll see a little bit of pressure coming through?
We will. So I think we should enjoy our last day in the target range for some time. Our house view is for around 6.5% for the December number, and I think we'll see the PPI the next day also coming out of deflation, turning positive. So those inflationary pressures are still underlying there. And I think there are a lot of technical issues, base effects from where we were this time last year in terms of inflation. That's pushing the number up for December this time, particularly in terms of fuel prices. So I think with that outlook, with the Reserve Bank only seeing us going back into the target range later in the year, I think that's also another reason for them to stand pat on rates.
There's another debate going on at this stage about the Reserve Bank, whether they should be widening their mandate to include growth and unemployment apart from just only inflation. Do you think that's a good idea?
Look, I certainly think they should have that debate. And the Federal Reserve, they base their policy on that kind of model, looking at growth and inflation, and it seems to work. Europe and the UK are more inflation targeting. So I think there's a lot of debate that has to go on just to see which model fits ours best. To just follow a target just for the sake of following a target is probably the wrong thing to do. And when it was introduced here, the whole inflation targeting regime, it was supposed to be a flexible system that did take those kinds of softer issues, if we can call it that, into account rather than just a fixed number.
Earnings in South Africa are not underway as yet. In fact, we should be heading into that territory in February. But in the US, we are seeing earnings beat expectations. 2/3 of earnings, in fact, have beat expectations so far. What are you expecting on the South African front?
Well, we've started to see some of those indications from the sales and the revenue numbers, as we said, from the retailers. So it's more on the likes of disappointment rather than any positive surprises. But I think the market is geared for low earnings. We're still looking for positive earnings growth over the year. I think the market probably close to 40%, but that's off a very low base that we had last year, and that's a year outlook. But I think if we look at the immediate numbers, we've got SAPI coming out this week. That's probably one of the first numbers, their first quarter numbers, and that Yeah, if we look back at the last year, their last quarter, they lost 20 US cents. A lot of that was special items. They did turn an operating profit for the first time in a very long time. So we just need to see where they go in this first quarter. It's 3 months is a very short space of time. Also towards year end, but let's see if they can turn that positive operating profit into a positive bottom line.
And of course, that industry we know has experienced a lot of overcapacity over the last couple of years. Would you be raining down on your exposure to equities at this stage, considering the markets have run quite significantly?
Yes, they have come back a little bit this year. I mean, it's been quite volatile for all those reasons that you mentioned as well. And we've come back from a near 18 PE back to below a 17 PE. So still in that expensive territory. We need those earnings to catch up. If we get 40% earnings growth, we can get to a PE of about 12. So your forward PE is probably around there. Still probably in the more expensive range. So I'd be very wary at the moment of diving in. I wouldn't necessarily cut back in a big way, but I think stock selection is what it's all about now.